am here with Charles from Gateway Mortgage Lending, or Gateway Mortgage, and he is going to walk through the 3 major steps of the home buying process. So I'm going to act like a first-time home buyer, and he's going to teach me the process of what it looks like with the questions being answered of what are basically like, what are my closing costs? Because that's a really big misconception. The other one that you had mentioned was
payments.
What are my payments, my monthly payments? So a lot of people know that as the PITI. What would that look like for me as a first-time home buyer? And then the third one was
escrow.
The famous, infamous, whatever you want to call it, word escrow. So let's get started.
Yeah, so I mean, today we just really want to just uncover some of the things and get into the details just a little bit so you understand the basics. And it's real important for me when I'm talking to a really a first-time home buyer to say, hey, do you understand the questions to even ask, right? What does it mean to have a payment? What is principal and interest versus what is the full principal, interest, taxes, and insurance? So I want to break down some of that today. And we'll start with payment, right? So you'll hear as we were just saying, you hear PITI, and sometimes you'll hear an A at the end. And really what this boils down is the makeup of it, the entirety of a payment, right? And when we think about it, the first one is principal. And what is principal? Principal is essentially, as you make a payment, this is bringing down, it's the portion of your payment that is bringing down the principal balance of your loan, right? Okay. So that is going towards the balance of your loan. And then the other portion that has to do with the lending portion is interest. So you're paying interest on your, so when we say, what is your interest rate? And you figure out your annual interest, that is being applied in your payment. It's amortized in your payment. So as you make these two together, you are satisfying, so to speak, satisfying the portion of your loan obligation every month, right? Principal and interest. This is bringing down your principal balance. This is essentially, if you could imagine, the fee that you're paying every month to have that loan, right? So that is what we think of when we think about payment as a lender, but there's 2 other important factors, and that's these 2 here. Taxes and also insurance, right? Now, these a lot of times are built into your payment. There are options, hear me when I say that, and it's rare as a first-time home buyer, but there are options if you're putting a significant amount of money, meaning 20% or more down, where you can pay these on your own. But most of the time, we will have these built into your payment. And so what's happening here with taxes is when we're estimating your payment, we are looking at the property taxes on that home.
Okay.
Right. So we're in this county, as we would any county, we're going into the appraisal district. We're looking at what the county has assessed that home at, what the tax rate is on that, and then what the annual taxes are. And we're taking, if you could imagine, 1/12 of that.
Now, why is it 1/12?
This is basically a year. So what is the monthly expense of your taxes built into your payment? Okay. And you'll see why that's very important as we get to escrow. And the very same for your insurance. And when you think insurance, think your homeowner's policy, your windstorm policy, which is required in Texas.
Hurricane,
and if you are in a flood zone, which means anything other than zone X, you will also be required to carry flood insurance. Now, if you're in zone X and you're not in a flood zone, it's optional. And we will not build your flood insurance in your payment. So know that that's optional. But if you are in a flood zone, in Texas, we require that be built in your payment.
And then what were if you could please just rename the 3 that are known for this area, since this is the area that we're focusing on. You said windstorm, you said flood insurance, and then you also said your homeowners,
also known as hazard. You'll hear them say hazard. They're interchangeable, right?
Okay.
So we will take, if you could imagine, all those annual premiums together, and we will divide that into 12 as well. Why? Because what is your monthly expense on that insurance? Right. And that is built into your payment. The A that you'll see sometimes is homeowners association.
Oh.
Now, we don't build that into your payment per se, but we qualify you knowing that would be a monthly expense of yours. So when we say this is PITIA, that's everything all together. That would be your entirety of your monthly expense. So is what people will make the big misconception to do. They'll go on a mortgage calculator, they'll figure just this portion, and they forget about taxes, and they forget about insurance, and they forget about a potential HOA that's in that area, and then they don't understand the entirety of their payment.
So not everybody is going to have the A. That's only if you live mostly in like a subdivision that has those yearly fees that you have to
yeah,
pay. Right.
Exactly.
Okay.
Exactly. So the thing that we want you to learn here more than anything is what is the entirety of your monthly expense so you can understand that and assess if that is good for you and your family, if that's fitting, right? So when I talk to people as a lender, I tell them I will always talk to you as PITI. I want you to know the entirety of your expense.
Awesome.
Now, I'll tell you the important thing when you look at this portion here, your principal and interest, 90% of loans are what we call fixed rate loans, fixed rate conventional or fixed rate FHA or things like that. They are fixed rate, meaning for the life of your loan, this will never change. It will always be the same every month. If I get a phone call 2 years after closing, they say, hey, Charles, you told me my payment would never go up on the principal and interest. And is what they don't understand is this can go up. Taxes are constantly changing. For the better, for the worse, most of the time for the worse, unfortunately.
Which is what I think a lot of us are experiencing right now is that the taxes have gone up significantly.
Right. As property values increase, taxes increase as well, right?
Okay.
And then also insurance. Insurance premiums over the years have increased as well.
Yeah.
So this right here is something you have a ton of control over, meaning you can quote that as many times as you want. You can change insurance companies as many times as you need to, so you can keep a close eye. I would say this is a lot harder to fight, the taxes portion. You do have the ability as a property taxpayer to go and fight taxes and fight the value of the home. Whether or not you're successful in that, I can't answer that, but definitely worth a try, right?
Yeah, well,
definitely worth a try.
I mean, people are doing that too right now. They're asking, I mean, I've had a few clients that have asked if they could have their home evaluation to see if they could fight the recent tax increase on their property. So that's something that you could consider, but this is difficult to try to change.
That is difficult to change unless there's some unknown thing that they have not seen, like condition of home inside is a lot of reasons why you'll win that. Maybe they're overstating the value because they don't understand the internals of the house or maybe some issues. But yeah, it's definitely a tough thing to fight.
Awesome.
But this will give you a broad scope of what a payment truly is. So if you find yourself going on a mortgage calculator, make sure you're looking up taxes or getting average tax rates and figuring that in there. And also make sure that you're considering insurance. And I tell people, if you don't know, say you're buying a $300,000 home or a $200,000 home. If you're buying a $200,000 home, just estimate $200 a month, 1% of it, $400,000 home, $400 a month, just to get a general idea and allot some money to that. You may not be spot on, but at least you've allotted some money and you've taken that into consideration. So you don't have what I call payment shock later,
right,
when these things are added in, right?
Yeah.
So what happens to this money that's really not for the loan? Like, where's this 1/12 of the taxes are going and where's the 1/12 of the insurance?
Yeah.
Well, this is where escrow comes in.
There's the word.
Yeah, escrow. So when we talk about escrow is nothing more than, if you can imagine, a savings account that the lender has for you. A lot of times I'll be asked, hey, Charles, can we charge for escrow? No, lenders don't charge for escrow. Escrow is free by law. We cannot. But it is a savings account that is sitting out there for you. And as you make a payment every month, the 1/12 of your taxes and the 1/12 of your insurance is going into your escrow account. It's building throughout the year. So two things can happen. One, in November, December timeframe, taxes come out.
Right.
The lender pays for your taxes out of this. And then also on the anniversary of your loan, right? When you closed your loan, what's going to be due? Your new insurance premium. It will also be paid out of this. So if you can imagine, it's just building a savings account as you go. And the reason for that is, and I tell everybody, it's really a lender's job is to remove as much risk as possible, right?
Right.
And this is how they remove some of the risk. They say, hey, if we get taxes and insurance as we go throughout the year, you don't end up with $4,000 or $5,000 worth of burdens at the end of the year.
Because you've already been paying. You've been paying.
You've been paying.
Right.
Basically, it's a lender going, let me help you save. right? Yeah. If you want to imagine that.
And protecting you. Yeah, cool.
So does that make sense on the escrow?
That
Megan?
makes me feel a little bit better because and we've had this discussion before, it's a savings account, which I appreciated that concept. I mean, for me, I have my bank account split in 4 different things. One of them is do not touch, and that is my my savings, if you will. But I mean, it clarifies it because I know that can be a daunting word.
Yeah, and this word, the reason there probably is so much confusion around this, it's used in a lot of different contexts. If you think escrow, when we talk about the title company and the person closing the loan, we call them the escrow agent, right?
Yeah,
escrow officer. And that's why is because they are distributing money.
Okay.
So that's why they get that title. But when a lender is talking about an escrow account, this is most definitely what they're talking
for your
about.
taxes and insurance.
Absolutely. Cool. So the next piece that I want to talk about is cash to close. And we'll call it CTC, which also means clear to close. But in this context, you can see mortgage, we love acronyms. Clear to close is what happens when we're about to close your loan. But I want to talk about cash to close.
Okay.
And when I talk to people, I tell them it's a little bit different when you're talking mortgage. When we say, hey, go buy a car, right? We don't want to talk to the person selling us the car about what's my monthly, because that stuff can get really deceptive, right? Mm-hmm. Is it a 5-year note? Is it a 6-year note? But if we know we're in a 30-year fixed note, right now, when I tell people when you're assessing how it's going to impact your life, number one, what is it going to cost you monthly? And number two, when you think cash to close, what do you have to bring to the table?
When you bring this up, though, cash to close, that can vary because it depends on what your insurance is going to be with whatever company, and also depending on where you live based off of flood insurance and things like that.
Absolutely.
Yeah.
And that's where, when you think cash to close, if a lot of people have this misconception, and a lot of this is because of ads you'll see on TV or things you'll hear on the radio, mm-hmm. we're a 3% down product or a 3.5% down product. And those things are very, very true. But when you're mathematically figuring what you're going to have to bring to the table, it's not just down payment. Right? So what makes up cash to close is, yes, down payment. It's very, very important. That is the first large portion of what your cash to close is. So if you're in a conventional product and you're in a new home buyer and you're leveraging on a conventional product, you can go as low as 3% down, 3%, $200,000 home, $6K, right? Okay. On a FHA, 3.5% down, $7K, right? So you can do that math very, very quickly.
You can do that math very, very quickly.
I can do that math very quickly. You just call me very
Yes, you can do that math very quickly.
Yes. This is where I don't want you to stop. And this is why it's really important to be on the phone with your lender as you're looking at homes and evaluating this in its entirety, because it doesn't stop here. The next piece is closing cost. In Texas, we go to a title company to close, and there are fees associated with that. There are lender fees associated with closing loans. There are a bunch of different costs, and one of the larger portions of this, and I would argue one of the most important, one thing a title company does is they issue what's called title insurance. Mm-hmm. And is what a closing company will do, or you can call it a title company, is they go back to the founding of the property, and they're going all the way through all the various ownerships. And
they do what's called a chain of title.
So they go
back and look at the whole history, the whole story of that particular property.
And why is that important? Is they're making sure there are no liens, mm-hmm. meaning no bills or debts that hadn't been satisfied that you end up with, right? So you buy a home, you go to sell your home 2 years later, Megan sells it for you, and they say, hey, in '84, there was a $100,000 lien on this property. You will be able to say, nope, I closed with a title company. They issued me title insurance, a title policy, and they are responsible for paying that because they didn't catch that. So that's one of the things that are built in these closing costs. So there's a bunch of various fees, deed fees, attorney fees,
filing fees, recording fees, and all of these words are just fees. I had someone in class, they said one time when we were in real estate class, they were like, when I've looked at actual title commitment or the receipt, not the title commitment, but the receipt that shows all of the different fees.
Closing statements.
Yeah, the closing statement. They were saying that I have to pay $25 for it to get mailed off. And it's like, well, that's not, it says that, but that's not where it's going to. You have to think of the carrier fees and all those different things that play into it. So the word fees encompasses several different things of where the money is actually going to.
Yeah. And just to give a general number, and there is some varying circumstances, let's just say it's 6 to 8K. So you have some general idea, right? And then the last piece that makes up cash to close is what we call in lending prepaids. Okay. And you were asking about this. This is where this becomes very, very interesting. So let's say we close a loan on May 15th. Your first payment isn't due on June 1st, it's due on July 1st. Mm-hmm. So let's say you start paying your payment. You've paid in July, August, September, October, November, December. You've paid in 6 months, and guess what? The tax bill has come. So what happens? Because if we just leverage this, you would be short in your escrow account. So when we say prepaids, we start to build up your escrow account and pay for premiums that are already there. So on the taxes, we'd grab that 6 months, plus we grab a 3-month buffer. That's to make sure if taxes go up during the year, there's enough money here. Mm-hmm. Now, this will be offset, the taxes will be offset from the time in which the seller lived in the home. So the seller, they say from the day you close back to the first, the seller will reimburse you the taxes based on what they are paying in taxes on that property, which could be different from what you pay just depending on the various exemptions. But there is some offset here, so know that, right? So you would see this go in as a prepaid and you would see some sort of credit unless...
That's what I was about to say. Like if you look at a closing statement, there's 2 different columns. You'll see the credit and you'll see the debit. And it'll say what the seller is crediting or what the buyer is debited, basically, off of those. And it'll show you the difference in the amounts.
And there are some exceptions. You take a 100% disabled veteran, they don't pay taxes, you would have no credit on that specific home if that was the scenario, right?
Yeah.
So if you could imagine that's being built up in your prepaids to supplement your escrow. The next piece is insurance. Well, insurance works a little different. Insurance, the premiums are required up front, meaning to have windstorm, to have homeowners, they don't say, hey, pay me monthly.
You have to pay up front.
You have to pay up front.
For the year?
For the year.
Yeah.
So 12 months goes into it to pay the initial premium. And then we're going to stick 3 months of buffer in there to make sure if insurance goes up, you're covered. Now, there is some limits here, and they can't overpile your escrow. So at the end of the year, sometimes you'll get a credit because there may end up being too much here, right?
Maybe that when you get a nice little check of maybe like $50.
Yeah,
it's like, hey.
Yeah. And I would tell you, if you do get to the end of the year and for some reason you get some massive check, and I had a buyer text me the other day, hey, Charles, I got a $2,500 check. There were some reasons for that. I advised him to put $1,000 back into his escrow and keep $1,500 of it, which was in fact overages for various reasons. Okay. But this will help you understand these 3 together become your cash to close. So you can see very, very quickly if you go into a situation and you think based on an ad that you saw that it's 3.5% down and you on a $200,000 home, and you said, man, if I save up $7,000, I can close on the house. That could possibly not be true depending on some varying circumstances. So this always leads to the question, once you add all these up, let's say $200,000 home, let's say, and we're just going to throw out an easy number, that's $20K. Charles, well, I have to bring $20K. Possibly. Depends on loan type and depends on varying circumstances. But I think just so you know, because it's what I don't want to do is deter you from considering buying a home, right? Yeah. There are programs here. There are down payment assistance. Megan, y'all negotiate seller concessions. Right. Maybe talk a little bit about what seller concessions are.
So seller concessions is basically, as the buyer, you're requesting the seller of the home to either help in certain repairs, or you're asking them to help towards the closing costs, which I'm in a situation right now with a client that the buyer has requested that they come with a certain amount of money allotted towards helping them with closing. It really just depends on the seller and the situation that they're in financially, whether or not they're willing to help, but that's part of the negotiation process between realtors to decide what's best for both of their clients. So, but that is, that's something. Now you said, and I'm just throwing out numbers, you said $200,000 home, you're going to have to bring $20K. So, I mean, roughly kind of guessing at 10%.
Yeah.
Okay.
And it's just me walking through the 7,
right? Just
plus 11,
together.
Plus your prepaids, right, plus your insurance, all those things.
And I can see why
and this
that's
could be
daunting.
18. But I just want to give you a general idea. Is what I want the message to be here is don't assume 7K.
Right.
There's other facets to that. But I do think it's important just from an educational standpoint as you're out there looking. And man, Megan, I would love for you to chime in. And I'll tell everybody, let's say you walk into a 200K home. You decide that you want to offer 190. There are a couple different options here as you step into this home and you want to offer 190. You can in fact go, I want to offer 190K. End of story, right? Okay. We're going to set your loan up as 190K. We're going to figure everything. We're going to amortize your loan. We're going to set up everything based on the 190K.
He said a big word. I just want to make sure everybody understands. Amortization, coming back to principal and interest. Basically, what happens as you pay out the life of the loan, the principal begins to decrease right? And
the interest begins to
Yes,
decrease and
so-
the principal begins to increase over time.
Thank you. And it's just a matter of it becomes less and less over the amount of time that you pay out the loan. That's
Absolutely.
what that word means. But they have this really cool, if you like numbers, amortization chart. I just like the word. But they have this really cool chart, and it shows you the process of time, where the numbers go and how they decrease and how they increase in the different
Payment by payment.
Yes.
Over 30 years. So there's a lot of payments.
Right.
But as you think about this, if this becomes a little daunting, you think, okay, what are my options? People will ask me, can I finance my closing costs? The answer on a purchase is no.
No.
But this is a way to somewhat finance your closing costs, right? So now we could come over here and say a little bit different on this offer. She just talked to you about what concessions are. We can offer $200K and ask for $10K in concessions.
Right.
Which means that they're going to contribute $10K to your closing costs, which now this $20K becomes $10K.
See?
And the loan is based on the $200K. And the beauty of this is the difference in $190K and $200K is very little in your payment. So you're in essence financing in your closing costs by the way that you structured your offer.
Right.
So the reason I tell you this is make sure you're conversing with your agents and talking about what are my options as I make this offer on this home.
Right.
Because that will have a huge impact on your cash to close.
Actually bring to closing. Okay. All right. Very thorough. I love the drawing on the board. I think for now, I don't have any other questions because you answered all of them. I wanted clarification on this. I wanted clarification on down payment and making sure that everybody understands that. So other than that, I think we're good.
Thank you, Megan.
Good.
Appreciate you.
Thank you guys so much for watching. Share, and if you have any questions based off of what we talked about today, the next session will probably go into more depth about different loan types or possibilities. But if you have any questions, feel free to ask and comment below. Thank you so much.
Thank you.